You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by Nasdaq. From its inception, Nasdaq has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. Nasdaq, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody. That music means it's time once again for Options Bootcamp, the program here on the old Options Insider Radio Network, where we break down the sometimes scary, opaque, impenetrable world of options and explain how you, the basic retail trader, the basic stock trader, can utilize these products in your own portfolios. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few programs for you guys to check out, including this fine program, the easiest place to get it all. If you're just listening to Bootcamp, first off, welcome. Secondly, you got a lot to catch up on. Easiest place to find it all, of course, the network feed. The primary network feed has all of our 15 shows, including Option Block, Volatility Views, the Advisor's Option, all the fun stuff we do, our daily news rundown, all that stuff there on the old network feed. Of course, you can always find it, iTunes, TuneIn, Stitcher, pretty much wherever finer podcasts are purveyed. You can also grab our mobile app, available for all of the major platforms. And we're mixing it up a little bit, doing a little bit of a refresh here on the old Options Bootcamp program. My usual cohort partner in crime, Mr. Passarelli, is on assignment today, but we've got some new folks donning the old drill instructor garb and the whistles to join us today. One of them will be familiar to you. He's made many appearances these days on the old Option Block program. I'll have to remember, I think this might be his second appearance here on the old Options Bootcamp show. Mr. Andrew Giovinazzi, the Chief Education Officer over there at Option Pit. Some know him as the Rock Lobster. Mr. Andrew Giovinazzi, it's been a while. It's been many years, actually. Welcome back to Options Bootcamp, sir.
It is good to be here, and I don't have my mute on, so I'm trying something new for my reemergence on this show, albeit even though it is just a temporary visit.
Yes, you're already ahead of the game. You haven't muted yourself once. Excuse me. I think the last time you were on, we went a deep dive into trade tags. So it's been some time, sir. Well done making yourself back here, making your way back to the old Options Bootcamp program. And also joining us, we're pleased to say, is our new co-host, our new drill instructor. We'll have to get her a hat and a nice whistle. She is Jill Malandrino. She's the global markets reporter over there at Nasdaq. Jill, welcome to the Options Bootcamp program.
All right. Well, thanks for having me. Great. Glad to be on the show with you guys.
And Jill, since you are joining us, you've been on the network a couple times before, but this is your first time on Options Bootcamp. As we are wont to do with all of our first timers here, why don't you go ahead and give our listeners a little bit of an overview of your background in the options space and how you found your way over there to Nasdaq.
Well, I'm still trying to figure that out myself, Mark. Thank you very much again for having me. And as you mentioned, I am the global markets reporter over at Nasdaq. Very proud to say that we've now went truly global, and we're starting to do some hits overseas. We were just in London last week, but we'll get into all that great stuff in a bit. Even though I'm in media, my background is from the sell side, having started in the equity space and making my way around from there. And with the financial crisis that kicked off in 2007, 2008, the last desk that I was on, they made the conscious decision to shut down equity and options trading, and I transitioned into media from there, which is how I met Andrew. Went over to the street, Jim Cramer's platform, and we launched an options product from there. And that's kind of how I got into the media world and affiliated with all of you guys. So it's been quite a ride, but I look at it like this, never having expected to end up in media. As markets evolve, so do we as market participants, and have the opportunity to focus on just about every asset class globally and meet and work with, some of the best traders on the planet. So it really has been an experience that you could really never, ever replicate.
Yeah, and I'm pleased to say that you're joining us here on the old Options Bootcamp program as part of Nasdaq's new initiatives there. Really, obviously, Nasdaq has always been a big player in the option space, but I think in the last couple of years, of course, they've really doubled down on options with the acquisition of essentially 3 more exchanges from the ISE exchange group. So Nasdaq, effectively the keeper of the keys to the kingdom of now effectively 6 options exchanges. So options are clearly near and dear to the hearts over there at Nasdaq, and they're represented by you, of course, here on the old show. So why don't you give our listeners a little bit of an overview before we get into some of the basic training for today, exactly why options are such a big push over there at Nasdaq these days, and what you guys are doing really to get the word out about options.
Well, it's really interesting about exchanges. One thing I've learned over the years is that they're hyper-competitive. And what I find refreshing what we do over at NASDAQ, we are big believers in investor education and advocacy. We have over 40% of the average daily volume on multiply listed options, and we take it very serious that it is our job to lead the way in terms of education and efforts. One way that we do it through my show, which is called Trade Talks, is we'll have experts on, such as Andrew or Mark over at Options Hit, and we'll talk about all different types of trends and strategies within the industry, and we could get as high level as retail trades, and we could even dig deep granularly and have a complex volatility conversation. So we have the ability to touch all different types of investors, and not even just with options, but with other asset classes as well. But this really is what our focus is. And what's great with doing it over a social media platform, and Mark, I'm sure you'll agree with this as well, is you have the opportunity to reach more people. It's not just exclusive to the institutional desks. You have the opportunity to get feedback from retail customers that have questions and they want answers, and they're clearly going to Twitter, Facebook, the podcast, anywhere to look for that kind of information. And I think as an exchange, as a leading options exchange, that it is our responsibility to make sure that we are accessible and reaching all those touch points.
Yeah, I was really excited when the folks at NASDAQ contacted us and said they're looking to get back into the retail education game, because quite frankly, that game hasn't been too popular over the last 4 or 5 years. You can count pretty much on one hand the number of exchange groups out there that still employ any sort of staff or educators or have an educational arm, or large retail brokerages who also used to do a lot of that retail education. A lot of them have laid off staff because they're all part of large for-profit public companies now. So education all too often viewed as an expense, not as an outreach or as a way to grow the pie. So a lot of firms have really slashed education. So to see NASDAQ starting to put that on the front burner again and away from the back burner, I think that's a great thing for all retail out there, because retail, last few years have been challenging for retail. We've seen their participation somewhat ebbing in the options market. So I think anything we could do collectively as an industry, and of course you guys as an exchange, to help grow that pie once again, I think it is a great thing for everyone out there.
Yeah, and I think it really is important that the industry does focus on retail. And another area that we've been hyper-focused on as well, with a lot of help from the Options Industry Council, which is a fantastic education platform as well, we've really been gearing our content towards registered investment advisors as well. I think that's one area in the industry has the ability, where you have the ability to gain market share. Only about 30% of RIAs are using options, but once they do incorporate them into their plans for their clients, they are sticking with them. So not only are we getting to retail customers, but you're starting to see it with the RIAs and the FAs, where they need this type of education because they need to educate their clients. And it's a big part of the industry that is severely underserved. And I think there's an awesome opportunity for us there. And that's something that we're going to continue to focus on as well, because it's just a big cycle of education there, and that's something that I'm excited to really work on. In fact, I would say about 30 to 40% of all of the content that we put out has the RIA and FA in mind.
That doesn't surprise me, and we know Eric and Frank and the team over at the OIC Advisor Initiative fairly well. In fact, we produce a show with them called The Advisor's Option, aimed specifically at that market. Now that I know you guys at Nasdaq are interested in that space too, we'll have to rope you on to that show as well down the road there, Jill. But with the team assembled, hats disseminated, whistles in hand, let's get to it, listeners. It's time for some basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, print bear to learn. Yes, sir.
All right, everybody, welcome to the basic training segment. This is, of course, the portion of the show where we typically break down a basic options concept and explain how you can utilize it in your own portfolio. And today we thought, what perfect time, refreshing the show a little bit with some introducing some new hosts and some new concepts. We thought, what better time to really refresh maybe the show, give our listeners a little bit of refresher on options as well. This show's been running for a long time. We've touched on many, many options concepts over the years. We get a lot of new listeners to the show all the time, and some of you maybe are unwilling or unable to go all the way back to the primordial ooze days of the show. I know some platforms like iTunes, too, usually limit you to the most recent 50 episodes, so it may be a challenge for some of you guys to go all the way back and find the earliest episodes if you're not getting the shows through our app or through our website or some other places like that. So we thought we'd do it for you. It's always good to have a nice basic refresher, a nice primer on all things options. So we're going to do that today and have a nice, really take the basic training concept and really embody it here on the show today. So let's get into it. If you're listening to the show, you're probably saying to yourself, why am I going to use options? I'm a stock guy. I like stocks. I understand stocks. So let's get into that. First off, we should probably define a few things. And in particular, let's start off with the basic concept. What the heck is an option? If you're tuning into this, you're saying, what is that? What is they talking about? Well, it's very basic. As the name implies, an option gives you the option, gives you the choice. It's the right, but not the obligation. That is the key. The right, but not the obligation to buy or sell a particular security at a particular date at a particular price. That's pretty much it. That's the lion's share of what you need to know in terms of what an option is. Now, obviously, there's a lot of terms that I just touched on there. We probably should identify and define a few of those for you. So let's go in order. You're probably familiar with a few basic option terms already. The most basic ones, call and put. Obviously, call gives you the right to buy a particular security or particular underlying at a particular price by a particular time. Put, the polar opposite of that, gives you the right to sell that particular underlying at a particular place at a particular time. That price, we're talking about the price you are allowed to buy or sell that particular underlying. That is called the strike price. So if you see that laid out in the contracts, that is a strike price in which you're going to buy or sell that particular underlying. You're hearing me use that underlying, that term as well. That's what the contract, these are derivatives at the end of the day. We don't like to use the dreaded D word because it scares a lot of people, but these are derivatives contracts at the end of the day. So their value is derived from the price of another asset. Usually for a lot of you, it's going to be stock because that's where you're coming from, but it could be a future, could be an ETF, could be a variety of things out there that is driving the price. And so that is going to be the underlying. If you buy options on Apple, for example, your underlying is going to be the Apple stock. And then, of course, the thing that's in there that scares a lot of stock traders first times as well is I mentioned an expiration date. Options come with an expiration date. It's like milk in your fridge. They're going to go bad eventually. So you have to figure out what you want to happen before that date comes. And that's usually one of the challenges that people have. Mr. Rock Lobster, another challenge people often have when they're talking about options is effectively, the notion of these options being exercised and assigned against them as well. Why don't you walk our listeners through those basic definitions as well as, this is kind of a basic list, but anything you want to add on there, have at it, sir.
You're asking me those complex questions again, aren't you?
Yeah, I'm setting you up for failure right off the bat here. These really hard questions.
Hedge fund or managing risk at a hedge fund with Mark to, having to figure out how to exercise options.
I'm starting you very high, sir. I expect a lot from you.
At least it's not the spread question. So basically, expiration or exercise risk. First, options have to be very in the money. And also, options are usually, unless it's a mistake, there's two different kinds. There's American options, which most equities are, and there's European options, which most cash indexes are. So most cash indexes, save the OEX, are European, and they're not going to. They can't assign you. Basically, you have to wait till expiration date, and then the options become cash. American style options are, you can exercise them at any time that you own them, and until the expiration date. And the big thing is cost of carry, meaning interest rate or dividends. So normally, if you are short in the money calls, and there's a dividend of high value, you could be assigned that short call the day before XD. So if you actually own a short call like that, you have to cover it. So the easy trick is anytime the put on the strike is worth less than the dividend, you most likely mathematically will be assigned. It's like 99.9% certainty. The only time you're really assigned puts is if you're short some puts and the stock goes down so far that you're in the money put you sold is now worth a lot of money, and somebody actually can assign you that so they can take the short stock. So those are the two ways you can be assigned short options. The third and funkier way is in a hard to borrow. So stocks that are heavily shorted, are they have what could happen is that you could actually be assigned in an off time, in a time where you would not expect, because usually stocks that are heavily shorted have no dividends. So you have to be kind of careful with those. So usually it's like the funky biotechs, stocks that are under, there's a lot of speculation, that they might go out of business, like Sears, I guess, is an example, where there's heavy short interest in there, and a lot of in the money calls get assigned on a regular basis. So those are really, I would say, hitting the key points of exercise and assignment for American and European options.
Wow, I just wanted some basic definitions. You got into American, you got into European, you got into dividends and puts and all sorts of stuff. So that's why I like having you on, Rock Pops. You see, you're trying to make up for the infamous spread question, which, by the way, I think there's another one lurking here in the listener mail. So maybe you'll have a chance to redeem yourself forthwith. But of course, hearing you talk reminded me that we still casually toss around a lot of terms maybe newcomers aren't familiar with, in particular in the money, at the money, and out of the money. What we mean by those terms is effectively these are options. If it's in the money, it's going to have some meat on the bones, what we would call intrinsic value here in the business, what you guys would probably just call some kind of inherent value in the marketplace. For example, if you have a call that you could buy gets you buy Apple stock, let's say at $95, and Apple is trading 100, it's going to have $5 worth of value. You can exercise it, buy the stock for 95, sell it in the marketplace. So it's got $5. It's $5 in the money. And then, of course, at the money would be if the option was for 100, the stock was trading at 100. I mean, it's right at the money. It's right exactly where the underlying is trading right there. Out of the money would be, let's say, the option to buy a stock at 105, and the stock is trading 100. Why would you exercise that option? Because you can buy the stock $5 cheaper in the marketplace. So that option is actually out of the money. You're hoping it will become in the money someday. That is the dream of all option buyers and the fear of all option sellers. We'll get to that in a little bit. But Jill, of course, you guys are always working with a lot of different retail, a lot of outlets, advisors as well over there at Nasdaq. Are there any definitions here on our basic definition list that we neglected you'd like to add to that list?
Yeah, actually, I want to go back to one of the more basic questions that you had asked when you were introducing the topic, and that was, I'm an equity guy, why should I look to trade options? Now, and we get this a lot from social feedback that we get, or some of the things that we do with the RIAs and FAs, and there really are retail investors out there who have no idea what an option is. So I would just like to let those stock guys out there know, stock girls, that options really are a forward-looking product, and they're an excellent way to get clues, even if you're not ready to trade options, but because they are forward-looking into what you're doing with your stock portfolios as well. So it really is good to have a working knowledge, if you're not ready to trade them yet, exactly what they are and what they can do to help enhance your portfolio or your trading. You know, it's really interesting because what you're hearing on the media, whether it's financial or otherwise, when is the market ever going to have a correction? How do I know when to buy all these stocks that I love, but I feel as if they're too expensive, or I don't have the capital to do that? Options give you that option, pardon the pun, to make money or protect your portfolio in an up, down, or sideways market. And I think that's why it's important as an investor to educate yourself. There's a number of things that options can allow you to do versus stocks. And one of them happens to be leverage, which allows you to kind of work around that capital situation and make it more of an efficient investment for your portfolio. So I also think another important reason to look into options as well is we're in a very low interest rate environment. And the common question is, how can I derive some income from my portfolio? Well, options help answer those questions. And I think that's why it's important for people who've only had equity exposure to really learn about the options market and see how they can supplement some of the concerns that they might have in an equity-only portfolio.
That is, of course, the number one question we get on this show. Why should I use these things? I'm a stock guy. I'm happy using stock or maybe an ETF. Yeah, we lump those all kind of into similar categories. Why should I use these things? And Jill hit on a bunch of them. Leverage is usually probably the number one reason people like to come to options. They get a chance to amplify what they want to do on the underlying. Now, there are pros and cons of that as well. Also, as a leverage, you get a lot of capital efficiency. It's usually much cheaper to buy an option, obviously, depending on where you're going. If you're buying a deep in the money option, it's going to be more expensive. Far out of the money option is going to be cheaper, but there are pros and cons to those as well. And of course, so that depends where you're trading, how much you're going to outlay for these options. But effectively, usually these things are going to be cheaper given the leverage factor. So your capital efficiency using options is going to be much higher. And of course, it gives you exposure to a lot of different facets of the markets you wouldn't get from just trading stock alone, like volatility. We'll get all that a little bit when we get into the Greeks. But first, Mr. Rock Lobster, you guys do education pretty much every day over there at Option Pit. You guys probably get this question, I don't know, conservatively a couple times a week. What do you, people ask you, why should I trade these things? What do you typically tell them? And then B, someone who's coming to us here or to you guys over there at Option Pit, who's used to just buying and owning a stock, how does that differ really from if he buys, let's say, a call option on an underlying?
Well, the biggest difference, one, is just you don't get the divvy. You don't get the dividend. So that's one thing. You could always exercise for it if you want. But the really big part is, you can have the same upside with a longer dated option with a fraction of the dollars, and you can take those dollars and you can just leave them in cash for a market opportunity. So just like what Jill was saying, the market's here. I don't know what to do. I want to buy something. There's some of these stocks I like, all this stuff. Instead of going all in and, 100 shares of stock on a $100 stock is, geez, what is that? $10,000. So that's not nothing, right? Instead, you could buy one or two call contracts that cost a fraction of that and leave the rest of the money in an interest-bearing account. I guess they kind of pay interest now. In the old days, it used to be an interest-bearing account. Now they just hold your money, I guess, and wink at you. But that's a way to do capital efficiency. So that's one of the Option Pit, one of the pillars is efficient use of capital when you are using options. It's one of the best things about them. So it also helps you. It also kind of allows you to sort of scale into a particular stock that you might want because you can pick entry points. You can pick entry points way below the market and see if the stock actually gets there. So what you have in options is, no pun intended, but you got a lot of options, and you can use leverage in clever ways that actually reduce your risk, your dollar risk, but give you more upside. And that's one of the magic things of using call options instead of stock if you want to get long. The thing is, you just don't get the dividend, and of course there's other things you can do about that. You can write calls and things like that, but I think that's the next level of the show, so I'll stop there.
Before you start scaring, I like that though. Options give you options. A little punnery going on over there at Option. Maybe that's your new marketing slogan over there at Option Pit. What do you think? Options give you options. I like it. Put it on your business card, sir. Maybe have a title for the episode. Maybe options. They give you options. But let's get into some of the basic parameters you need to know if you are trading options as well. You probably, if you've even tangentially dug your toes into options over the years, you've probably heard this term, the Greeks. These are the main risk parameters, the main variables that tend to define your risk exposure when you're trading options. So let's go. This there's really going to be 4. We'll throw in, make it 5, because one of them is getting a little bit more relevant, but still not much. So you have delta, gamma, theta, vega, and let's just say sometimes rho. It's like A, E, I, O, U, and sometimes Y, that sort of thing. So rho sometimes on the horizon, not too much these days, but maybe sometimes. Delta, of course, giving you the rate of change of your options price as the underlying moves. So if you have a delta of 50, your underlying moves $1, your options price moves 50 cents. Very basic. Now you get a little bit more sophisticated, you get to gamma. Gamma is the rate of change of delta. I know, oh my goodness, a rate of change, a derivative of derivative, craziness, dogs and cats living together, mass hysteria. But gamma just shows you how much your delta is going to change. Delta is not a static variable. It's important to keep that in mind. So as the underlying moves around, as different parameters change, volatility, all these things change, your delta is going to change. Time to expiration, that changes. So these things will all affect your delta. So it's important to know how that gamma tells you how much that delta is going to change as these parameters, particularly the stock, changes. Theta is, of course, you mentioned before, the expiration date. It's a key factor when you're talking options. All options expire. We have one of my cohorts, one of my old shows used to say options die a little every day. And that's true because they approach their expiration every day. So a little bit of that value comes off, a little bit of that bloom comes off the rose every day that they approach expiration. So you have to bake that into your trading. You have to understand how much of that impact is going to be every given day. That's what theta tells you. So it's a handy thing. It's a little bit scary for people who buy options, and it's a nice, happy thing for people who like to sell options. So I guess it depends what side of the coin you're coming at it from. And of course, Vega being the option sensitivity to changes in volatility. You know, the old saw has always been out there that retail traders tend to focus on delta, professionals tend to focus on Vega. I think there's some room for theta somewhere in the middle too, but Vega is definitely what you need to understand if you're going to trade options. Volatility is the name of the game at the end of the day. Whether you realize it or not, you're a volatility trader if you're trading options, so that's important. And of course, I mentioned Rho, kind of the redheaded stepchild of the Greeks. It's an option sensitivity to interest rates, and so you might see automatically why that one hasn't really been on the radar for the last 5 years or so, because interest rates haven't really been on the radar. But as that starts to perhaps change over the next year or so, we might see Rho come back into the conversation. Jill, you obviously do a lot of options outreach over there at Nasdaq. Spent a lot of time doing this over there at the street and other outlets as well. So I'm sure you probably discussed the Greeks, 8 million times conservatively at this point. Anything you want to add in there, and any points you like to emphasize when you're talking about the Greeks to a typical retail stock audience?
All right. Well, I'm excited to be on the show with Andrew because a lot of what I learned about vol and the Greeks really has come through option pits. So
that explains it. Now I understand. Now I understand what's going on over there.
Exactly. That's why I can't trade my way out of a paper bag. No, just kidding, Andrew J. But no, those guys really are the experts over there, and that's where I've done a lot. And I would say on a very basic level, two of the Greeks that you probably want to be most mindful of when you're looking at retail, I would say delta and theta. It's probably a little bit easier of a conversation to start off with. You know, delta simply measures an option position sensitivity to the changes in the underlying asset. So, for example, if the stock was up $1, the option position could profit or lose by the amount of its delta. So that's something that you really want to focus on. It's kind of like looking at it in terms of a percentage. So, for example, if your delta is at 35, the option positions could make or lose 35% as much as the underlying stock. So that's something that you want to be sensitive of. That's, again, where that leverage comes in. Of course, theta, whether you're buying or you're selling an option, you're either going to make or lose money as time passes. So theta is the decay part of the options equation. So for those two Greeks, I would say when starting out, they'll probably be the ones that you're the most sensitive to.
Mr. Rock Lobster, same question for you, sir. Which Greeks do you emphasize when you're over there instructing the newbies over there at Option Pit? And then also, I'm sure you get this question a lot. I'm a stock guy. I'm coming to options. Why the heck should I care about volatility, sir? So have at it, sir. I know that one's near and dear to your heart.
Oh, wow. So you could do like 50 shows on these two questions, by the way.
Easily. At least 25 to 30.
At least. So what I teach, because a lot of the people that come to Option Pit are refugees from other places, services, trading systems, whatever, that tried something that worked for a while, then it went all horribly wrong. So I would say from an education point of view, everybody, and Jill's right, most retail are interested in delta and theta, right? I want to be long, I want to be short, and I want to collect some premium. when I sell stuff. Once you become a kind of what I would say a little bit next level, I spend most time trying to get our traders to understand about gamma, the different types of gamma, where you place it, how it affects you, how it changes the strategies that you make, because ultimately that is part of the risk control piece, how you understand how gamma works. And so that's what I say. I think personally that's the most important thing. So give you an example, the financial crisis, nobody was short any gamma, where at the closing level somewhere in April, once the market melted down and volatility went to the moon, everybody was short lots of gamma. So that the actual Greeks itself, they change. They're there to tell you what the option is going to do down the road. So when you're new to options and you look at these blinky screens, right, you just see all these numbers and you go, okay, in the old days, it used to be 1 1/4, 1 3/8. Now they're all decimals, so it's not as much fun. So, it's 110, 125, 130. But you're trying to say, how are these things going to move? How does, when anything happen, this option, how is it going to respond to what the market does? The best way is understanding how Greeks work. So most decent platforms have a good, let's just call it a Greek profile, where people can see all the different factors that make the options move. One of the major factors is volatility, as you said. So actually, Option Pit is pretty much dedicated just to teaching traders how to trade volatility. And volatility as an underlying movement. Volatility affects options in different ways, like we just talked about. In the money, at the money, out of the money are all affected a little differently by volatility. Time to expiration a little bit differently with volatility. So what it does is you use volatility in a way that's going to help you accomplish the goals of your position, whether you want to be long the underlying, short the underlying. Either way, so volatility helps you price the options, and it actually gives you a good idea of what the market's actually charging you for the position you want. And a lot of that, I firmly believe, obviously I'm partner in an education firm, that, the more you know how the option is going to perform, your better chance of success. So that's what we do. So volatility is key, gamma is key, but what Jill says, theta and delta are kind of the money makers for you, right? Gamma is important from a risk control point of view, but your delta and theta end up being the money makers of the position. How you manage your delta, your directional exposure, basically being long or short the underlying. And theta is just how much your options are rotting in your favor, or how much the decay is bleeding away, much to the sadness of many of our people that don't like long options. I think that you call that the dark side. But anyway, that is what I think about, the Greeks. What's important from a risk management point of view, and what's really important from how do I make some money with these option things, being delta and gamma. I would say Vega, which is the last one, is very directly volatility related. I think that is probably the most misunderstood Greek, just because of how important it is to positions of different time frames. So, like I said, I could do 25 million shows on these subjects. Actually, I said only 25, but you probably could do more. But that's what I think about, at least the Greeks, from trying to be as simple as I could be on the basic concepts there.
As you mentioned, you could do many, many episodes on these topics. Luckily for you, we actually have. This show's been running for many years, so this is just a basic overview, a basic refresher here. If any of these concepts intrigue you, by all means, go search through the archives there for topics like volatility or the Greeks. We've done multiple shows on the Greeks. My usual cohort, Mr. Passarelli, has written books on the Greeks, so we talked about them many times on this show. So all these topics we've broken down in much more detail in full episodes. Again, this is just a nice little refresher for you guys and a lot of you newcomers who are discovering the show all the time. Now, we should mention the focus. Most of our conversation so far has been focused around basic buying of options, but options are not just for buying. You can sell them as well. And that's where things get sometimes a little bit tricky for newcomers, a little bit counterintuitive. Usually you're familiar with just coming in, buying a call, buying a put. You have that basic bullish or bearish exposure to a particular stock. And now let's flip that script a little bit. Now you can indeed sell these. I've said before, if you buy a call option, it effectively gives you the right to buy that security at any time during the lifespan of that option at that price. Well, if you're selling that to someone else, effectively you are guaranteeing that right for them. So you are now agreeing to sell that particular underlying at that particular price by that particular time. So if the underlying moves against you, you will have to sell that stock or that ETF, whatever it is you're trading on. So just be prepared for that. And the puts, the same side. Of course, if you buy a put, that gives you the opportunity to sell that underlying at any price, or excuse me, at any time during that option's lifespan at that guaranteed strike price. If you sell that put now to someone else, you are guaranteeing to them the right to sell that stock at that particular price, which means you are in turn guaranteeing to buy it. So see what I mean by how it gets a little bit counterintuitive sometimes. We'll walk through some examples of that in a little bit, but it is worth noting that options are not just for buying, they are indeed for selling. In fact, quite a few of the people on the pro side, as Andrew alluded to, the dark side, do like to sell options. So that's something as you get a little bit more sophisticated in the space, you may want to explore, and it's certainly selling options in conjunction with long options as part of spreads, also a great way to proceed. Let's talk about some of those strategies now you might want to utilize, you may have heard of, or maybe basically familiar with in the option space. And the most basic option strategies there are, the ones most people tend to start with. Usually it's coming in and they're bullish on a stock and they want to buy a call on. That's usually how the vast majority gets started. A few will come in and buy a put because they're bearish, but usually it's the former. People tend to just think that way. I think they like to have, they're generally bullish by nature. They look at an underlying. They think of the options in that delta context we were saying before as a way to get exposure to the movement of the underlying, and so they like to come in and buy a call on that particular underlying, and then of course they can turn around and buy the put that they think is going to drop. Now you can start thinking already in your head probably of how you can combine these strategies, perhaps with the stock. For example, instead of just buying the put, thinking the underlying is going to drop. Now, of course, let's say you own XYZ stock and you're afraid it's going to drop below 95. It's trading 100. It's going to drop below 95. You can buy that 95 put, and now you've effectively stocked yourself out at that price for the duration of the option's lifespan, which is a nice thing to do. You can also combine buying or indeed selling options with the underlying itself. For example, a lot of people like the covered call, a very popular options trade as well. Very popular trade for beginners because it generates some income. Let's say, again, you own the XYZ stock. It's trading for 100 right now. You think it's going to rally to 105. If it does, you're comfortable selling it there. So you sell a call effectively at 105. Now you've created a position known as the covered call, and it allows you effectively to sell that stock at that price during that option's lifespan. And then, of course, if it gets there, it's going to get called away. And then, of course, by doing that, you're getting paid for that option, which that contract, which is a nice thing. It's much preferable to just working basic limit orders in a stock buy and sell orders, because guess what? No one pays you for those. If you're selling options to do it, you do get paid, which is a nice way to go. And, of course, very basic strategy people like to employ, as well as a typical, what we tend to refer in the business, vertical spread, which means effectively you're buying and selling two options in the same expiration month. So maybe this year you're looking at XYZ stock. You think it's going to rally by the end of the year. You may buy one call option. Maybe it's at the money where the stock is trading now, and then you sell another one slightly out of the money. You've created what's called a basic vertical spread. So these are just some early, very basic strategies. Jill, when you're out there talking to the masses at Nasdaq or in your many previous incarnations over there at the street and others, what were some strategies you like to discuss with them, or some basic entry points to get them into the options market?
You know, it's really interesting. This conversation has come up a lot in a market that continues to move sideways to higher, and that is when you look at selling puts as a potential stock replacement strategy or as a way to derive some income. And Andrew, as you know, there's a lot of people that will say, selling premium, that's like picking up nickels, nickels under a bulldozer, whatever that expression is. But there are times where I think it is appropriate as you get more comfortable with options trading. And just to remind everyone, think about it like this. An equity option, it's a derivative security, like don't be afraid of the D word. And it really just derives its value from the underlying stock that it covers. So if, let's say, for example, you want to buy one of these high-tech flyers that you don't think that either the level is appropriate or you think it could potentially come back in, selling puts are a fantastic way to use it as stock replacement, right? So as a put seller, you have the obligation to buy the stock at a predetermined price if that buyer puts that option to you. Now, if the stock doesn't go any lower, you collect that premium that you did for selling, that you sold that contract for. But if you like if you like stock XYZ at 90 and it moves to 85, and that's your way of acquiring the stock, you got it for $5 cheaper. And if you fundamentally love it that much, or if you like the chart longer term, that's another way that you could potentially acquire stock without going into the open market if you want to get it at a specific price, or collect premium if you expect it to go higher. And in a market where it is increasingly more difficult to generate income, that is certainly one of the ways that you can do it. And we hear a lot more of people getting interested in selling puts and using it as a stock replacement vehicle if they're looking for some sort of correction or just some sort of a tick to the downside.
Yeah, that harvesting of the old risk premium, to use the technical term that's getting bandied about a lot these days. Selling puts to do that has become, shall we say, de rigueur in the options market. Mr. Rock Lobster, same kind of question for you. A lot of people are approaching you as basic stock guys looking to dip their feet in the options waters. Which way do you usually direct them? I know obviously it depends on what they're looking to do and things like that, but let's say in general, 10,000 foot level, people come to you. What are the basic strategies you tend to recommend first as their entry point, their gateway into the options market, if you will?
Wow, that is a good question. As an entry point, probably most of our clients want to get long in some way, shape, or form. And they want to know the best way to do it, best risk-controlled way to do that. So for me, a strategy would be, I like combining multiple put spreads with long puts. I like that as kind of a put-selling strategy when things are a little more volatile, because it gives you a little move. It's probably a little advanced because there's a couple of moves there. You got to do stuff with the strategy, but it does work pretty well. My clients, a lot of them like it because it gets them what they want. I think the most important thing with any option writing strategy is, what are you prepared to do with anything you sell? So you have to have a pretty good sense of what you can do. I think most people run into trouble with options, or all the stuff you hear about them is when I think they over leverage. They have too big a position for what really they can handle. And that kind of causes problems. And if you sort of right-size things, that helps you a lot. So generally, I think for most people, I think selling put spreads would probably be better than naked puts, because you always have controlled risk. You don't have to sell a put spread, but I've had so many mentoring sessions with clients like, I'm just going to sell these junk puts in the SPX, okay? And the market's down like 2%, the vol blows up, volatility blows up. And a put they sold for like $2.50 is now worth $9, okay? Most people don't like that. But if you sell a put spread, you're going to be down some money, but only a little bit. And you can keep some perspective. So the idea is, I think a lot of our clients like that as a strategy. We have a lot of them in our chat room. A lot of our pro clients sell a lot of spreads. And they do well because they're pretty patient, and they use risk control. They understand what they're doing. So I think that's very important for those type of strategies, and especially if you want to get long, because you can get long at a discount, and getting long at a discount sometimes is a pretty good thing.
That's always a good thing. I like it. All full of technical terms I get today, Mr. Rock Lobster. People don't like when puts go from $2 to $9 in their face. I can get on board with that sentiment. Unfortunately, we're going to have to wrap up our basic overview. It's amazing how fast these episodes fly by when we're having fun, when we're talking basic options. But before we go, let me check back in with each of my cohorts here. They'll have their final thoughts maybe on some takeaways they want you to take away from this basic options episode. We'll start with you, Jill. If you have something you want to leave our introductory listener on this episode, something they want them to walk away from this episode remembering, what would it be?
You know what? The platforms that are available for retail traders are light years ahead of anything that I ever saw when I started in the business 20 years ago. And I think that's the biggest advantage that they have. Research, read, paper trade. I cannot recommend enough paper trading. All the platforms have it. I use Thinkorswim. They have it. Every other platform that I've seen has it. It is, options are different than equity trading, and it takes time to understand the motions and how the math and so forth behind it works, even though computers basically figure all of that out for you. It's just a different type of concept, and I can't recommend enough reading and practicing and not going all in. Certainly go for the singles and doubles in options trading for sure. Don't swing for the fences or home runs, and take it one step at a time. Certainly, if you have an opportunity to work with a mentoring service like what Andrew does, I would take complete advantage of that, but do not take advantage of the education and tools that are out there is the biggest disservice that you could do for yourself.
And Jill, I know you guys, like you mentioned at the top of the show, you're putting on a lot more content aimed at this space, both on the retail and the advisor side, as well as your tech talks. If our listeners are interested in that, they want to learn more about what NASDAQ has to offer on the options front, where should they go? What should they do?
Well, we broadcast live on Twitter under the Nasdaq handle, and of course mine, which is Jill Malandrino. So you could just go through there and see the different types of segments that we have out there. We also broadcast quarterly from our new PhilX options trading floor. It's still the open outcry, and we're also on Facebook and LinkedIn. There's a ton of content out there. We have some of the top minds in the industry joining us for all these different types of segments, and it really is valuable to get their insight. And again, take the opportunity with all the educational tools that are out there. And NASDAQ is proud to be leading the way in the media space when it comes to that.
Indeed, and look forward to more from NASDAQ on this show in the coming weeks and months. In the meantime, check them out over there at NASDAQ. If you're not doing so already, follow them on Twitter at NASDAQ so you can see all of Jill's broadcasts there and all of her trade talks and all the other fun stuff they're doing over there in the NASDAQ options space. And Mr. Rock Lobster, same question for you as we wrap up here. What would you like someone to take away with this, from this basic options overview, this basic options refresher, the one concept that should really resonate with them going forward?
My simple introductory rule is know where you're going to get out before you get in. So you want to have some success with options. Figure out how you're going to get out of whatever you got yourself into. And if you can do that, you will have a much better chance to succeed, because then you actually have a realistic understanding of what trade you just put on.
Well said, sir. And if people want to hear more from you, if they want to take some of your mentoring for themselves, where should they go? What should they do, sir?
Well, they go to optionpit.com, sign up for our mentoring, any of our multiple levels of courses. We actually probably the only mentoring firm that actually taught guys can teach somebody how to trade and send them back onto a trading floor. I don't even know of one that has done that. Since we're all ex-market makers, it seems to be the easiest thing to do. But we can teach you from basic to as advanced as you need to go. So optionpit.com for us, and look for my Easy VIX class coming up very, very soon, early October.
There you go. Check it out. Hope you guys enjoyed this refresher here on Options Bootcamp. I know you guys love this show. You've been hitting us up like crazy saying, when's Bootcamp coming back? When's Bootcamp coming back? Well, it's back. It's here. And don't worry. I know you guys have been hitting us up with a lot of questions as well. Don't be upset. We didn't get to any this show, but don't worry. Next episode, we're going to answer a whole bunch of your listener questions. So don't write me angry emails saying you haven't answered our question yet. We'll get to them soon. On behalf of Jill and Andrew and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show. And of course, for sending in those questions. Keep them coming, and we'll see you next time for more Options Bootcamp.
Options Bootcamp is brought to you by Nasdaq. From its inception, Nasdaq has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. Nasdaq, tech forward, leading the U.S. options market and continually rewriting tomorrow.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.